Good morning, everyone. My name is Gina Buchholz. I've got just about 10 o'clock. Like I said, I still see a few people hopping on the call, but I think we'll go ahead and at least get started with introductions. And again, thank you for joining our webinar today about participant behavior in volatile times. For those of you who are familiar with our team or have joined other webinars, you probably know many of us, but just to introduce the rest of our team, there's Kristen Carlin, Jessica Ballin, Jenna Witherby, and Kelly Panic. And this is part of a webinar series we've been hosting more and more this year. Obviously, we're working in a virtual environment, so and we have a lot of things to talk about, many timely topics, but most of these webinars are less than 30 minutes. Again, a variety of topics, and we are trying to bring you some of the most timely and relevant information. We've got 10 webinars scheduled in 2020, and all of our past webinars you can find on our website at 401kplanprofessionals.com and also on our YouTube channel. In addition, this webinar is being recorded, so we will send out a recorded link if you've registered, and feel free to share that with your colleagues or anyone else who might find this webinar beneficial and helpful. So again, at the end of the presentation, I will provide you with our website and YouTube channel information as well. So we certainly appreciate you using that as a helpful resource. So again, today we want to talk about participant behaviors and the concerns that employees have, because we are now several months in the midst of this pandemic. And as we know, there's a lot of anxiety. There's anxiety with regard to health, and there's anxiety with regard to financial wellness and retaining your job. And so we recently collected some data just to kind of get a pulse on what employees are feeling. And this data found that about 36% of Americans are very or extremely concerned about their finances. And about 22% of those have, or someone in their household, either that individual or someone in their household has experienced a job loss, or they've been furloughed or laid off. In regards to health, about 30% of respondents said that they're very or extremely concerned about health issues, and about 15% have reported that they or someone that they know have tested positive for COVID-19. So obviously those impacted the most, those that have incurred a job loss or a pay cut, or those that have been impacted from a health standpoint, those are the most concerned. And also interestingly, the study broke this down generationally, and I thought this was fairly interesting. The study found that millennials and Gen Xers, and I happen to be a Gen Xer, tend to fall into the categories that are most concerned about their finances and their health, even more so than baby boomers who are closer to retirement. So I thought that was interesting, but you do have to remember that baby boomers were in the height of their career during 2008, 2009. So baby boomers have maybe had this experience, kind of, I've gone through this before, and I've recovered, and I stayed the course, and everything was okay. So, and that's really a big theme of what we're going to talk about today is really how to temper those anxieties and encourage people to stay the course. So what we've seen, again, obviously employees are understandably concerned about their retirement assets. They've seen a lot of market volatility. The S&P 500 actually, it dipped 30% below its high in mid-February. So, but interestingly, since then, we've also seen some of the market's best days. We've seen some very bad days, but we've also seen days in the market that have been very good. And it's interesting, over a 20-year period, and I've got some data to support this, we've seen some of the best and worst days in the market occur within weeks or even days of each other. So with all of this market volatility, it's up, it's down, what do your participants do? Well, let's use past data to kind of examine behaviors from the last financial crisis in 2008 and 2009. And because during that time, the market dipped almost 49% and volatility hit an all-time high. And some of the themes, some of the messages we were telling people then are exactly the same thing we're telling them today. First of all, don't panic and don't act on your emotions. This is not the time to sell out of your investments. and lock into those losses. Don't do that. Don't have that knee-jerk reaction. Stay the course. We'll talk a lot about having an appropriate investment allocation and the importance of that. But most of your employees, if they've worked with us or a financial advisor or they're using target date models, they're probably just fine, and we want to encourage them to stay the course. We also want to continue to encourage, keep saving regular contributions, because one of the beauties of a 401k plan is it provides dollar cost averaging. And what that means is just the nature of 401k contributions. They go in every pay period, and sometimes they buy the investments when they're high, and sometimes they buy investments when they're low. And when you buy investments during this time when investments are lower, that's going to reduce your average cost over time. So it's a great time to keep saving, dollar cost averaging, buy when it's low. And lastly, we really want to discourage market timing. Even the most brilliant stock analysts and economists out there, this is difficult to predict because there's so many unpredictable things that happen, like a pandemic, that we really don't want to encourage market timing at all. It's never really proven to be very successful. So again, stay the course. So again, back in 2008 and 2009, we took some data and lessons from that, and we found almost 97% of participants continued to make contributions during that time, which is fantastic. We certainly hope that trend continues during this period of market volatility and during this pandemic. Withdrawal behaviors generally did not increase, and more than 85% of participants did not make an investment change. So that's, again, fantastic. Because the good news is, even historically, we look back, by 2010, once that financial crisis ended, the total value of assets in participant accounts had recovered. And not only that, but then it was followed by a 10-year period of a bull market. So it really did pay for those people who stayed the course. They kept saving. They saw their market value. They saw their retirement account value recover and subsequently prosper. So this is just a quick exhibit of how the retirement assets, obviously you can see in 2007, they were at a pretty high level. In 2008, that was a big dip. And again, if you were a 401k investor at that time, I'm sure you remember how that felt to pull up your 401k account and look at it and see that it significantly dropped in value. But again, over time, slowly and gradually, it recovered and then some. And again, it was really, really a good time in the market. So again, those who just persevered and stayed the course definitely paid off. So, and this is one of our favorite slides, and I think it's a great exhibit about why you want to stay in the market. This is an exhibit that shows an investment of $10,000 if you invested that in the stock market on January 2000, so 20 years ago, 2 decades ago, and you kept it there until December 31st, 2019. That $10,000, again, if you would have just kept it in the stock market, you didn't move it, you didn't make any market timing decisions, you didn't make any changes at all, that $10,000 would be worth over $32,000. At the end of that 2-decade period. That's an average annual return of over 6%. So pretty impressive. And you have to remember in that 2-decade period, we saw a lot of bad times. We saw the tech bubble at the turn of the century, and SARS, 9/11, and then of course the financial crisis in 2008, 2009. It was certainly not all rosy. It was a very, very volatile period. But again, persevering and staying invested obviously proved to be the best course. And interestingly, if an investor had missed the 10 best days, so again, this would be market timing going wrong, where you missed the 10 best days in the market, your average annual return would have been about 2.44%, significantly less, and that $10,000 would have only been worth $16,000. And if you would have missed the 30 best days in the market in that 2-decade period, your average annual return would have actually been negative. So again, just missing some of those worst days can be really detrimental. We look at 2015 as an example. In 2015, the worst day that year was August 24th. If you would have moved your money on that day, you would have missed the best day in the market, which would have been 2 days later on August 26th. So again, you feel bad. It doesn't feel good when we hear these or see these market declines. But again, staying the course, oftentimes we do see these good days in the market follow very quickly. So just some interesting data there, again, just to support, stay the course. And a couple of behaviors that we want to continue to acknowledge. Certainly this pandemic has made it very challenging for employees. And first and foremost, I want you to know our team is empathetic to that. We want to be very cognizant of the challenges that everyone's facing. But we also want to encourage them to continue to make contributions and avoid taking withdrawals if at all possible. Now is a great time to reinforce good behaviors. Continue to save consistently, and try to save at a level that maximizes that employer match. And one thing, if any of you have ever seen our financial wellness presentations to your staff or your employees, or any of our webinars or presentations, one of the first things that we always tell people, one of the most important financial decisions that you need to make is to ensure that you have an emergency fund, first and foremost. And I would tell someone who doesn't have an emergency fund to build up that emergency fund even before they save in their retirement account. And now more than ever, proves why this is so important. And an emergency fund, it should be invested separately, obviously, from your retirement assets. It should be invested maybe in a savings account or some type of investment that is easy, liquid, and easy to access if you lose a job, if you need some money to cover, day-to-day expenses, car breaks down, roof leaks. That's what an emergency fund is for, so you don't have to tap into your retirement assets, which are really being invested for the long term, and could be subject to early withdrawal penalties and taxes and things like that. So an emergency fund, very important. I encourage people to have about 3 to 6 months of savings in that emergency fund. And again, really there to avoid having to take withdrawals from your retirement account. So we definitely want to encourage that. And then a couple of things regarding participant behaviors and with regard to their investment portfolios. One of the things we've always preached and educated on is that every individual needs to have a well-diversified portfolio based on their age and their risk tolerance. And, one of the general principles in investing is, when you're younger, you can afford to take more risk. As you get older and closer to retirement, hopefully you've built up a nest egg, and now it's time to protect that nest egg. So that's very important. We hope that each and every one of you and your employees have established a well-diversified portfolio. And one thing that has really helped us achieve this is that most 401k plans have target date funds or models. And these models, again, take into account oftentimes certainly age, sometimes risk tolerance, and typically they generally become more conservative automatically as that person gets closer to retirement. So those are some important investment principles that we always teach, and they're more important now than ever. And rebalancing is another important concept that we talk about. Target date models, custom models, they will do this. But what rebalancing simply means is if you decide that you need an investment portfolio that's 60% in stocks and 40% in bonds, at some point in time, over time, that might get out of balance, and you need to rebalance back to that 60-40 mix. And again, professionally managed models, target date models will do that for you. But if you're investing on your own, you want to kind of keep in check that your account doesn't get out of whack, to what you initially had found appropriate for you. So just really basic investment principles. And here's why having a diversified portfolio is so helpful in managing these volatile times. And this is a great slide. It really shows 3 different scenarios. The green bar shows if you had your money invested 100% in stocks, the S&P 500. The light blue bar shows an investment allocation that's 60% stocks and 40% bonds. And then the dark blue bar is more conservative with 40% stocks and 60% bonds. So that top bar probably more appropriate, for people starting to approach retirement. But again, from most aggressive to more conservative. And you can see back in 2008, 2009, if you had been invested 100% in stocks, you would have experienced, or you did experience, the worst decline compared to someone who had a balanced portfolio. And over time, we also know that historically in this instance, that the balanced portfolios recovered about 17 months quicker than those invested 100% in stocks. Now, I will point out that if you are invested in stocks, your lows will be lower, but your highs may be higher. But again, having a balanced portfolio helps people manage some of these volatile times. So I think that's a great illustration to remind us why we want to stay diversified. And I think this is a great slide. I know it's very busy and it has a lot of data, but really what this slide illustrates is 5 times in the last 100 years where we've seen a market recession or even a depression. So 5 times, that includes the Great Depression, also World War II. And in the 1970s, that's when we experienced pretty high unemployment and high inflationary period. The turn of the century, I call that the tech bubble. And then, of course, the financial crisis in 2008 and 2009. So these were 5 periods historically that were really, really bad. In fact, it shows the decline in each of these crises. And the Great Depression experienced a decline in the stock market of over 86%. And in 2008, 2009, which many of us probably recall, felt, that experienced a decline at one point of negative 56%. Now, so that's obviously, these were obviously some very difficult and challenging times in our history. But what's interesting and what this slide wants to show you is what happened after that. What happened in the 5 years after that, and almost with just a couple of exceptions. The first, second, third, fourth, and fifth year after those crises, there were pretty significant market gains. And this is really telling us that, stay the course, because, oftentimes after these big crises, we can catch the upside. So it shows, the 5-year average return after each of these crises, with an average annual return for the 5-year period of over 23%. And then if you're a person that likes to put those in dollars and cents, in the Great Depression, had you invested $10,000 at the Great Depression, 5 years later, that $10,000 would have been worth $46,000. And likewise, after the financial crisis in 2008 and 2009, your $10,000 would have grown 5 years later to over $30,000. So again, really just staying the course, persevering, not making investment changes, continue to buy when the market's low and ride it up when the market goes up. Because, this pandemic is a little bit different than anything. Well, it's very different than anything. We've never experienced a pandemic, but we do know we have some of the smartest people in the world working on treatments and vaccines. And, when that happens, and we can all go back to work and feel safe and achieve some normalcy in our lives, that would, it would certainly seem to be the time when we're going to see an upside in the market. So it will come. We just don't know when. And lastly, I just have a couple of slides too, because we've gathered some data on how plan sponsors are dealing with this and some of the biggest concerns that plan sponsors have. Obviously, they're focused on monitoring these behavioral trends of their employees and their staff and their colleagues. They're obviously establishing operational readiness for the CARES Act provisions. Many of you joined us for our CARES Act webinar. That was a couple weeks ago. Again, that's out on our webinar, or out on our website if you'd like to take a look at that. But the CARES Act, for those of you who aren't aware, this provided some tax relief for those impacted impacted by COVID-19, where they could, if the retirement assets were the last place to get money, they could access their retirement assets and get some special tax treatment. So again, most plan sponsors did adopt those provisions and are already ready if that comes up. But also, education, communication to your employees is very important. That's where we, as your 401k advisors, we want to help. So if you do have any of your employees that come to you and they're concerned, maybe they've exhausted that emergency fund, they may need to consider tapping into their retirement assets, please, I encourage you to have them call us, and we can kind of walk through their options and hold their hand through the process. So also plan sponsors, just like us, you're doing everything virtually, or many, many things virtually that you never did before. So finding digital solutions, and obviously helping furloughed and laid off employees is a big concern and taking up a lot of a plan sponsor's time. But really, just to drill that down, the top three employer concerns are the overall well-being of your employees. And I commend all of you. We talk to so many of our clients, and I know many of you are working hard to make your work environments safe, but yet productive, and keeping your employees safe and everyone healthy is top of mind. But when it comes to the financial wellness and market volatility, again, that's where we can help as your advisors. So again, lean on us. We've done so many different presentations on market volatility. You'll find a great one out on our website. We've customized those for clients. We'll talk to your employees. So again, continue to encourage them to call us, use us as a resource. We can talk through some ideas to help you. One thing I did want to mention too, there was a recent study to see what plan sponsors are doing with regard to those CARES Act, and 96% of plan sponsors have adopted the CARES Act distribution and loan provisions. So I know most of our clients have adopted these provisions. Only about 4% didn't, and those that didn't cited that they did not want to encourage withdrawals from retirement assets, and we certainly agree with that. This isn't something that we're going to promote, like, hey, you can get your money out of your retirement assets, you don't have to pay early withdrawal penalties, you get some tax relief. We do not want to encourage that. We don't want to sidetrack people from their retirement goals. But it is there if you have an employee who really has exhausted all other means of income, and they need money to keep a roof over their head or food on the table. So we're hoping that your employees do not have to tap into their retirement accounts. Quite honestly, we have not had a lot of calls or inquiries about it. So I'm hopeful that most people can persevere and get by with their retirement savings or a little help from the government until we can all get back to work. But again, most plan sponsors did adopt those CARES Act provisions. And the good news is a lot has changed since 2008. We've really, really gotten a lot better. I think, we have better tools to help people diversify their investments. We have more education now to remind them to stay the course. One of the big, I think, things that came out of 2008 was the target date funds. These really have grown about tenfold since 2008. And I think what happened is people who were getting close to retirement in 2008, and maybe they were invested too much in stocks, they realized what a detriment that was. Again, the target date models help your employees invest appropriately for your age, and they gradually become more conservative as they get closer to retirement. So your employees who are in a target date model, you can be assured that as they're getting closer to retirement, their money is not going to be invested as risky, and it's not going to be subject to as much volatility. So that was I think one of the best things that came out of 2008 and 2009. It really reminded people you really do have to invest, for your age and your retirement date and your risk tolerance. A couple other things that came out of that environment too. There's definitely been more auto enrolling, auto features, getting people into plans, automatically saving them, getting them to save for their retirement, and then auto increasing that. So, increasing their contributions by 1 or 2% every year, just doing that for them automatically good behaviors that we're enforcing. So continue to do that, but those are some of the great things that came out of the last financial crisis. And again, just in conclusion, continue to encourage our employees to stay the course. I know I used that term a lot today, but we don't want them to respond to this emotionally or try to attempt to time the markets. We want to keep them on track and stay the course. So, and also emphasize that 401k programs, they're designed to help them stay on track. It's easy. It's right out of your paycheck, your dollar cost averaging. Continue to use those auto features. Again, most of our clients have target date funds or models in their plan. That's a great way, to invest for the long term. And again, provide resources to them, on market volatility, the CARES Act, if they have questions about distributions in 2020 or loans or loan deferment during this pandemic. And again, I think our team can provide you with a number of the resources that you need to continue to educate your employees, to continue to keep them on track. So again, here's some information on how to reach us, our website or our email, YouTube channel. Jessica, Jenna, and myself are all advisors here and happy to talk to everyone. Here is our website, www.401kplanprofessionals.com, and of course our YouTube channel as well. You'll find some great topics out there that you can share with your staff. And again, we just want to thank you for your time today, and also encourage you to join our next webinar, which is going to take some of the concepts we talked about today and kind of expand on those. The next webinar will be in 2 weeks on Thursday, May 28th. That'll be hosted by Jenna and also our partners at JP Morgan. That's also at 10 a.m. Central Time. It's a little bit more, we're going to dive a little bit more deeply into plan design to help empower your employees for retirement success. So it's a great one to follow our conversation today. So again, we just want to tell you thank you for your continued loyalty and support, and just remind you that we're here as a resource for you. Thank you very much for your time today. Have a great day. Stay well, stay safe, take good care of your employees, and we appreciate everything you guys are doing.